if I told you that legally, a significant portion of your retirement savings could be sitting in a heavily armed underground fortress right now?
That is quite the image to start with.
Right. I mean, not just a digital number on a screen or, a fractional share of some tech company. I'm talking about literal physical bricks of precious metal guarded by actual security teams.
Yeah, it's a completely jarring concept for anyone who's used to just, logging into a brokerage app and seeing their balance. We are so heavily conditioned to trust the invisible digital spreadsheet.
Exactly.
So the idea of tangible vaulted wealth, it feels almost medieval.
It really does. But welcome to another deep dive. Today, our mission is decoding the highly complex and honestly often misunderstood world of gold IRAs.
And it is complex.
Very. We are looking to answer a really specific question for you today. Is moving your hard-earned retirement savings into physical gold a vital, impenetrable shield against economic chaos? Or is it just this convoluted trap designed to drain your savings through, hidden fees?
Right. And to cut through all the marketing noise, because there is a lot of it, we are relying on a really robust stack of materials for this deep dive.
Oh, for sure. We've got this comprehensive Gold IRA resource directory and comparison guide, and we are anchoring our entire analysis on an extensive research guide authored by Doug Young.
Which is fantastic because Doug's credentials really need to be highlighted here.
Yeah, let's establish those before we jump in, because in the financial sector, context and experience are everything.
They absolutely are. He isn't just a casual market observer.
Yeah.
The man has over 20 years of experience in financial markets.
Wow.
And more than 15 of those years are specialized entirely in gold IRAs and precious metals trading.
And you have to add his 16-year tenure as the financial director at World Freight Services, Ltd. So he brings this really deep logistical understanding of how global assets actually move and retain value out there in the real world.
Exactly. He's also authored over 500 published financial research articles. But the metric that really stands out for our purposes today is his evaluations.
Right, the company evaluations.
Yes. He has conducted more than 80 distinct gold IRA company evaluations just since 2011.
That is a lot of fine print to read.
Oh, that means digging through 80 different fee schedules, interrogating 80 different custodian partnerships, checking the storage contracts. We are leaning on some serious battle-tested expertise today.
Which is absolutely paramount when we're talking about the strict regulatory framework governing your life savings. You just cannot afford to rely on surface-level marketing when the IRS is involved.
No, the IRS does not play around.
Okay, let's unpack this. We all know how traditional retirement accounts work, right?
Sure.
You put money in, you buy some mutual funds or maybe target date funds, and you sit back and watch the numbers hopefully go up. But what actually happens behind the scenes when you decide to back your future with literal physical precious metals?
To understand if a gold IRA is actually worth the hype, we really have to look at the mechanical differences first.
Yeah, so what is the primary distinction?
Well, it really comes down to the account structure itself. A traditional or a Roth IRA is typically managed by a standard brokerage.
Like your Fidelity or Vanguard.
Right, exactly. And they only deal in publicly traded paper assets.
Hmm.
But a gold IRA is technically a self-directed IRA, or an SDIRA.
Okay.
That self-directed classification is the actual legal mechanism that gives you the authority to hold alternative, tangible assets.
So you are essentially partnering with a specialized trust company to rent a physical vault, which then holds gold, silver, platinum, or palladium strictly for your retirement.
Exactly.
But the paradox here is how the government treats it. Despite being this very physical alternative asset, a gold IRA offers the exact same tax magic as those digital paper IRAs.
It does. The tax code applies the exact same protective umbrella. So if you utilize a traditional gold IRA, your initial contributions might be tax deductible, and you benefit from tax-deferred growth.
Meaning the IRS doesn't tax your gains until you start taking distributions when you retire.
Precisely.
Yeah.
Or, alternatively, if you opt for a Roth Gold IRA, you fund it with after-tax dollars. The growth is entirely tax-free, and your withdrawals in retirement are completely tax-free.
Okay, let me push back on that premise for a second.
Go for it.
If a gold IRA has the exact same tax benefits as a regular digital IRA, why go through the immense logistical trouble of buying heavy metal?
That's the big question.
I can pull out my phone right now, open my brokerage app, and buy shares of a gold ETF, an exchange-traded fund that tracks the price of gold in about 4 seconds. Why am I renting a vault?
Well, what's fascinating here is the distinction between paper exposure and physical possession.
Okay.
When you buy a gold ETF, you do not actually own gold.
Wait, really? What do I own then?
You own a fractional share of a trust, and that trust is managed by a financial institution, which in turn leases or holds the gold. You are introducing counterparty risk.
Ah, so if that institution goes under?
If it fails or if the financial system just freezes up, you basically just hold a piece of paper. A physical gold IRA completely removes that counterparty risk. You own the actual asset.
I see. Which ties directly into the historical function of the metal itself, right?
Exactly.
We hear this term inflation hedge constantly in financial media, but the sources actually break down the mechanics of why it functions that way.
Yeah, it basically comes down to purchasing power versus fiat currency.
Right.
Fiat currency, like the US dollar, is fundamentally backed by trust in the government that issues it. When the economy tightens, central banks can and do just print more money.
Which dilutes everything.
Exactly. That expands the money supply and dilutes the value of every single existing dollar out there. A dollar today objectively buys a tiny fraction of what it bought 20 years ago.
But gold is a finite, elemental resource. You cannot print it. You can't just code it into existence.
Therefore, historically, it retains its purchasing power. When paper money weakens, it just takes more of those weakened dollars to buy that same exact ounce of gold.
Right. It acts as a safe haven asset.
Yes. During severe economic downturns, when the stock markets panic and corporate earnings collapse, investors instinctively flock to tangible assets. Holding a physical safe haven provides this tactile sense of economic security.
Because you possess an asset with intrinsic, globally recognized value that doesn't rely on some CEO's decision-making.
Precisely.
I completely understand the psychological comfort of that. Holding a physical asset in a world of digital chaos sounds incredibly appealing.
It does.
But that exact physical nature introduces a whole host of real-world logistical problems that digital stocks elegantly avoid.
Yeah, you really cannot escape the realities of physical ownership.
To put in perspective, buying a gold IRA is a bit like buying a pet elephant.
A pet elephant. I love that.
I mean, think about it. It is an incredibly impressive thing to own. It's powerful, it's weighty, it definitely turns heads, but you have to pay an absolute fortune to house the elephant. You have to pay specialists to feed and care for it. And if you ever want to move it, the transportation logistics and costs are just massive.
That is a perfect analogy.
Yeah.
The hidden fees in a gold IRA are directly tied to housing and caring for that metaphorical element.
Let's break those fees down specifically, because Doug Young's research makes it very, very clear that this is not a cheap endeavor. And these costs actively drag down your returns.
They do. Because you are dealing with a self-directed account and physical commodities, the fee structure is entirely different from a standard Vanguard or Fidelity account. First, you encounter setup fees.
Okay.
Opening a self-directed IRA requires complex paperwork and IRS reporting that standard brokerages just don't do. So the specialized custodian charges you just to open the door.
Just to get started.
Right. Then you have annual maintenance fees paid to that custodian for keeping your account compliant with tax laws year after year.
But the real financial drain is the storage, isn't it?
Oh, absolutely.
Because you cannot legally keep this gold in a safe in your basement or like a shoebox under your bed. The IRS rigidly mandates that IRA-purchased precious metals must be kept in an IRS-approved depository.
Yes, and these depositories are essentially high-security, heavily insured, third-party fortresses. Think Brinks or the Delaware Depository.
Okay.
And they charge ongoing storage fees for taking up physical space in their vaults. There are even different tiers of storage.
What do you mean by tiers?
Well, there's unallocated storage, which means your gold is mixed in a vault with everyone else's. And then there's allocated or segregated storage, meaning your specific gold bars down to the actual serial number are kept in a separate private cubby.
Let me guess, segregated costs more.
Naturally, segregated storage costs even more.
Right. So over the span of a 20-year retirement plan, those compounding custodian and depository fees take a serious bite out of your overall wealth.
A massive bite.
Which brings us to another massive realization I had while reviewing the sources. And it's a really crucial mechanical detail for anyone considering this move. Gold does not pay rent.
No, it is a non-yielding asset.
Exactly. If you buy a stock, that company is theoretically building products, making profits, and paying you a quarterly cash dividend.
Right.
If you buy a bond, you are lending money and earning a fixed interest rate. Your money is actively working to create more money.
But a brick of gold.
It just sits in the dark, gathering dust and looking shiny. It does not generate a single cent of internal income.
which fundamentally alters the mathematical foundation of your investment.
Yeah.
Because there is no yield, no dividends, no interest. Your entire potential for profit depends 100% on price appreciation.
Meaning someone else has to pay more for it later.
Exactly. Someone else at some point in the future has to be willing to pay more dollars for that exact piece of metal than you did.
That puts an immense amount of pressure on the market price just going up forever. Let's look at the math here.
Let's do it.
If gold prices remain perfectly stable for a decade, your investment doesn't just stall, it actively shrinks.
Yes.
Factoring in the annual custodian and storage fees we just outlined, a stable gold price means your retirement account is bleeding money year after year.
That is the hidden danger that a lot of people miss. To merely break even, the price of gold has to appreciate enough each year to cover your administrative and storage costs.
So if the entire strategy relies on the price going up to offset those fees, we really need to look critically at how the price of gold actually behaves out there in the real world.
We do.
And this leads to a common assumption I really want to push back on. A lot of investors think gold is this stable, unmoving rock in a stormy sea. But the data in the sources says otherwise. Here's where it gets really interesting.
You're referring to the volatility myth.
Yes. The research explicitly emphasizes that gold is actually highly volatile. It is not just a straight, smooth line pointing up.
Not at all.
In fact, there have been massive historical periods, sometimes lasting a decade or more, where the price of gold plummeted or traded completely flat.
The mechanics of gold pricing are driven by massive, often unpredictable macroeconomic factors. We're talking about geopolitical conflicts, sudden shifts in global currency values, supply chain disruptions.
The panic basically drives it.
Pretty much.
Yeah.
When sudden panic hits the global stage, gold prices absolutely spike because institutional and retail investors simultaneously rush to that safe haven.
But the critical question is, what happens when the panic fades? Let's say a recession ends, inflation cools down, and the stock market starts a massive multi-year bull run.
Then the fear dissipates. And when the fear dissipates, the premium demand for gold drops significantly and prices can plummet. The opportunity cost becomes massive.
Wow.
If you happen to reach your retirement age during one of those stable, highly confident economic periods, the market value of your gold IRA might be significantly lower than what you projected.
And even if you are lucky and the price is sitting at an all-time high right when you want to retire, you can't just easily tap into those funds to buy a house or pay for medical care. The sources highlight what is essentially a liquidity trap.
Yeah, liquidating physical commodities is a friction-heavy process.
Think about the contrast. If I want to sell $10,000 worth of an S&P 500 index fund, I open my app, tap a button, the trade executes in milliseconds, and the cash is sitting in my account ready to transfer.
Instant access.
Exactly. With a gold IRA, you have to actually execute a physical transaction. You have to instruct your custodian to sell. They have to find a bullion dealer willing to buy it.
And you are subject to the dealer spread.
Right. Meaning they will buy it from you for less than the current market spot price so they can make a profit themselves.
And you still have to deal with the logistics of safely transporting heavy, valuable metal out of a high-security depository.
It sounds like a nightmare.
It is not a fast process, and it is definitely not a cheap process. That lack of immediate liquidity can be a severe issue if you are relying on those funds for mandatory minimum distributions in retirement.
Or if you face a sudden medical emergency, you are strictly bound by the physical constraints of the asset.
I mean, we haven't even touched on the most unforgiving aspect of this entire vehicle, which is the IRS strictness.
Oh man, the regulations.
The regulatory compliance required here is intense. The IRS does not treat a gold IRA like some casual hobby for coin collectors.
No, they draw a very hard line between an investment and a collectible. Standard IRAs are legally prohibited from holding collectibles.
Exactly. To ensure your precious metals qualify as financial instruments, the IRS demands an incredibly strict purity standard. For gold, it must be at least 99.5% pure.
So I can't just throw some vintage gold coins, a rare European sovereign, or like a gold watch in there and claim a tax deduction?
No, absolutely not. It has to be highly refined, investment-grade bullion bars, or very specific, IRS-approved government-minted coins.
Like the American gold eagle or the Canadian gold maple leaf?
Right. If a coin derives its value from its rarity or historical significance rather than its pure metal content, it is disqualified.
And the rules surrounding the movement of the money are just as rigid. The sources emphasize the mechanics of the rollover process.
Yes.
If you want to move money from an existing 401k into a gold IRA, you cannot just withdraw the cash into your personal checking account and then go buy gold.
That triggers the dreaded 60-day rule. If you take possession of the funds, you have exactly 60 days to deposit them into the new IRA.
And if you miss it,
If you miss that window by even 1 day, the IRS treats the entire amount as a taxable distribution. This is why the sources stress the importance of a direct custodian-to-custodian transfer.
where the money moves directly between the financial institutions without ever touching your hands.
Yes, that is the only safe way to do it.
And going back to the physical storage issue, the penalties for violating the depository rules are staggering. I mean, there are always advertisements floating around claiming you can set up a home storage gold IRA and just keep the gold in a personal safe.
Oh, the IRS aggressively pursues those setups.
I bet.
If you attempt to take physical possession of the gold yourself before the legal retirement age of 59 and a half, the IRS considers that an unqualified distribution.
Which means your entire account is instantly subject to standard income tax, plus a massive 10% early withdrawal penalty.
Exactly. One misstep in compliance, one single misunderstanding of the depository rules can completely wipe out the tax advantages you spent decades trying to build.
When you aggregate all these factors, it presents a pretty daunting landscape.
It does.
You have an asset with high logistical setup and storage fees, zero built-in yield, high macroeconomic price volatility, slow liquidation speeds, and a literal minefield of IRS regulations.
It sounds incredibly discouraging when we stack it all up like that.
Right. So what does this all mean for you? How does a rational, savvy investor actually utilize this tool without getting burned by the fees and the red tape?
Well, if we connect this to the bigger picture, the answer really lies in understanding the tool's actual mathematical purpose. A gold IRA should almost never be your entire retirement plan.
It is strictly a tool for portfolio diversification.
Yes, it's a specialized defensive player on your financial team, not the star quarterback.
Oh, I like that.
Because gold lacks yield and carries those heavy liquidity constraints, you have to balance the scales. You pair your gold IRA with traditional income-generating assets.
Like dividend-paying stocks, mutual funds, interest-bearing bonds.
Exactly. The traditional digital assets provide the aggressive growth, the compounding interest, and that immediate liquidity we talked about.
While the gold provides a resilient, tangible floor.
Right, a macroeconomic shock absorber for when inflation spikes, currencies devalue, or the stock markets crash.
And most financial consensus suggests allocating only, 5 to 10% of your portfolio to these physical metals?
That's the generally accepted sweet spot, yeah.
And because the rules around this defensive player are so complex, strategy and partnership are everything.
Okay.
Which is exactly why Doug Young's comparative market analysis is so vital to this discussion.
Oh, totally. He recently evaluated the top 5 performing gold IRA companies for the 2026 landscape.
And his evaluations don't just look at the shiny brochures, right?
No, they dig into all the mechanics we've been discussing. The companies that make his top 5 are the ones that systematically minimize these pain points.
They act as the guide through the minefield. Honestly, given all the IRS compliance hurdles, the 60-day rollover rules, the complex depository setups, trying to DIY a physical gold retirement account is just a terrible idea.
It really is. Picking a highly reputable provider is the only way to safely navigate the red tape. A top-tier provider acts as a central hub.
Right. They facilitate that direct custodian-to-custodian rollover so you don't trigger a taxable event.
They ensure the metal you are buying actually meets the strict 99.5% IRS purity standards.
They coordinate the secure shipping.
And they have established partnerships with vetted IRS-approved depositories, like the Delaware Depository, to secure the most competitive storage rates for you.
Furthermore, the best companies solve that liquidity trap we mentioned. They offer robust, transparent buyback programs.
Which is huge.
Yeah, meaning when you are ready to retire, you don't have to go hunting for a dealer. They will liquidate the metal for you at fair market value and distribute the cash.
They essentially manage the elephant for you.
They do, but you still bear the ultimate responsibility of deciding if you need the elephant in the first place.
Yes, and that brings us to a really crucial disclaimer.
Good point. We are diving deep into the mechanics, the risks, and the benefits of these accounts strictly for educational purposes. But personal finance is deeply, deeply personal.
It is. Evaluating your own retirement timeline, your specific risk tolerance, and your need for liquidity is paramount.
Consulting a qualified financial advisor who actually understands the entirety of your unique situation is an absolute requirement before you initiate any rollovers or sign any contracts.
Absolutely.
Yeah.
They can look at your entire digital and physical portfolio and mathematically determine if a gold IRA actually complements your long-term wealth strategy.
So to bring it all together, a gold IRA is a uniquely powerful diversification tool. It offers incredible tax advantages and a historically proven, tangible shield against the devaluation of fiat currency.
But it is not a magic wand.
No. It requires paying ongoing rent for storage, accepting zero internal yield, weathering periods of high volatility, and rigidly navigating strict government regulations.
It is an investment vehicle that demands extreme patience and a very clear, unemotional understanding of the global macroeconomic forces at play.
If you are considering adding this specialized layer of protection to your retirement strategy, we highly recommend you do your homework on who to partner with.
Take your time with it.
Absolutely. You should absolutely go to the Gold IRA Company's bulletin website at goldiracompaniescompared.com for a wealth of detailed information. That includes a deep dive into Doug Young's 2026 comparative analysis of those top 5 companies.
It's a great read.
Again, that is goldiracompaniescompared.com. And to make it incredibly easy, there is a direct link to this right in the resources below in the notes for this deep dive.
It is an invaluable resource you will definitely want to review before executing any transfers.
For sure.
But, before we wrap up today's analysis, I really want to leave you with one final, broader thought to ponder.
Ray it on us.
Well, we have established today that gold produces no actual income.
Right.
It doesn't build software, it doesn't manufacture goods.
Right.
Its returns rely entirely on the premise that someone else will be willing to exchange more fiat currency for it later.
Which means its entire value is essentially just a collective historical psychological agreement.
Exactly. So as we move deeper into a purely digital, tech-driven 21st century economy, an economy that's built on artificial intelligence, blockchain, and invisible data, you have to ask yourself a fundamental question about the future of wealth.
Will that ancient psychology hold up against modern technology?
That's the question. Will future generations who have grown up entirely immersed in digital ecosystems and frictionless digital currencies continue to honor the inherent perceived value of a heavy yellow metal? When you finally open that physical depository vault 20 years from now, are you securing an eternal, impenetrable economic shield, or are you simply banking your entire retirement on a 5,000-year-old human habit?